Welcome to Retirement, the Great Escape Plan. I'm Jenny Brown, CEO of JBS Financial Strategists and author of Retirement, the Great Escape Plan. This podcast is about rethinking retirement, not just the numbers, but the life you're planning for. In each episode, the JBS team, along with special guests, will explore real conversations, real experiences, and the decisions that help people approach retirement with clarity and confidence. Because thriving should be fun and naps should be epic. Let's get started. Markets wobble. That's normal. The real question is this: how do you structure your money, your mindset, so you don't panic sell the life you've worked so hard to build? Today, Warren, Hanna, Peter Folk and I are unpacking how retirees can stay calm, stay invested and still sleep at night, even when the headlines are loud. So I'm Jenny Brown and welcome, guys.
Thanks, Jen. Great to be here again.
Yeah. So this is a conversation we have a lot with clients, especially once they're retired and the markets start making noise. Warren, when markets get noisy, what's the very first sentence you say to a retired client who's getting really anxious?
Oh, good question. Thankfully, most of our clients actually don't necessarily get very anxious when markets are there because we have been educating them and training them over the years. But I guess the major thing I would probably say to someone who is nervous is that we've seen it before. Portfolios are put in place to be able to weather the storm for exactly the periods we're going through right now.
Exactly. So, Peter, what's the most common fear you hear in those moments? Is it I'll run out, I'll lose it, or I've done something wrong?
First of all, just want to say thanks for having me today. We got right into it today, so I missed my opportunity, but I just want to say hi. To be honest, I think it's a bit of all of the above. It is that real fear. And I guess the two biggest fears is, that they're going to run out of money. The market's, reacting the way it is, and it's going to have a really detrimental impact on my lifestyle, and I'm suddenly going to run out of money overnight. And that's a big thing. And sometimes that's because, past experiences that clients have had where, they have unfortunately lost money in investments, potentially because they haven't made the right decisions and things like that. But that's the underlying fear I feel like clients have. It's that I am going to run out of money, or suddenly, as we touched on in an earlier episode, this is all the money I'll ever have. And therefore there is that fear that it is just going to be taken away from them.
Yeah, good point. So to each of you, why does market volatility feel so much more personal once a client or once somebody actually stops earning an income?
For mine, it's because it is so much more relevant to their particular situation right there and then. So building up to retirement, the investments are there, and people obviously take a longer term view because they can't access their super in the majority of cases if that's the way they're funding their retirement. But once they start drawing on it and they see a balance change, even if it's only on paper, it does have that personal reaction, the fact that, oh, okay, that actually means something. And then if they relate that to a particular value of, a holiday or whatever it is that they see their portfolio drop by, that's where it does feel a lot more personal. But that's where you've got to actually stay the course, put it in perspective and talk them through it, I guess.
Yeah. Peter, what do you think's actually happening in their head when they open an account and they see red?
Yeah, a lot of clients I deal with, it is that panic. As Warren said, it's, they've gone from a situation of they're working, they've got a regular income coming in. Now they're relying on this lump sum of money to effectively replace their wage. And so when they jump in, they're seeing this sea of red, the initial reaction is, again, like what we touched on before, it's that, oh, what's going to happen to my retirement nest egg? This is all the money I'll ever have. And am I going to lose this? Something going to happen overnight that suddenly, I'm going to go from $1 million in super, for argument's sake, down to 700,000. And what's that impact going to be on my lifestyle?
So what do you want them to remember in that moment?
Again, that we're investing for the long term. So, markets are always going to go up and down and things like that. But what they need to realize is, and we've seen history shows and what we teach a lot of clients, there's always going to be a blip on the radar when it comes to markets. But markets and you stay the course and you keep to your investment strategy that we put in place in the first, when we started the retirement journey, it's still valid now. And long and short of it, and we'll get into it a bit more, we build bucket strategies with clients and we help them understand, well, we've got enough money in cash to ride out the volatility. So let's not react. Let's just stay the course. Let's trust in the strategy that we've put in place, because over time, we're going to get back to where we were.
Yeah, it's good learnings. So in my book, I talk a lot about the idea of volatility is normal, but behavior is absolutely everything. And the plan matters more than the headlines. So, Warren, tell us about a time a client wanted to sell down during a downturn. What was really driving that urge and what helped them pause?
Yeah, good one. I reflect back one conversation I had with a client very, very early on in my career where we were talking about BHP of all stocks, and we were talking about the fact that there had been that correction. It must have been around GFC time, I guess, where it dropped right down. I think it was even in the teens at the time, and the client was nervous because they had a big exposure to BHP. They wanted to sell before it dropped even further. The emotional side was really driving that, around the nervousness of seeing the value go down and down. And we had a real conversation around that, and the fact that reality was it still was a blue chip stock. It still expected to dig the same amount of resources out of the ground that they always were going to be, and the fact that it really was a sentiment decision rather than necessarily a practical one. And by the end of the conversation, the clients actually bought BHP at the same price rather than the reverse. And so it's just having that conversation and that putting things into perspective and understanding that, when the market drops, the only people who get hurt are the ones who have to sell. And so if you're in a position where you don't have to sell, why would you? So if it's a quality asset and the longer term reason for holding hasn't changed, well, staying the course is generally the way to go.
Yeah, absolutely good point. There's no point selling when the market's down if it's a quality asset.
Mm.
So, Peter, in your experience, what changes the outcome more? The investment itself or the plan around the investment?
Definitely the plan around the investment. So, as we touched on there earlier, we always put in place an investment strategy for our clients. And again, I'm sort of getting ahead of ourselves. We always talk about a bit of a bucket strategy with our clients. So for us, it's I always look at when I'm having these conversations with clients and they're logging in online, they go, I've got a sea of red here. It's making them understand, well, what you're looking at now is paper losses. They're not actual real losses. They become a real loss the moment that you sell out. And that's when, if you react to that, that's when you make some big mistakes. So what we do is we make a plan around their investment, build an investment strategy that we can ride out these little bits of volatility. We can ride out these little dips in the market, and we've got this tried and true tested investment plan for them that we don't need to react to the sea of red or the headlines.
Yeah, absolutely good point. Warren, back to you. We often talk about the importance of staying invested for the long term, and Peter touched on it just before. What does that actually look like in real life? And especially when the news feels really scary.
It can be a challenging thing for clients, particularly when the news is there. But what I try to reiterate with our clients is that, bad news sells newspapers, or nowadays social media posts, or the nightly news on the. It's interesting. You come home and you see on the news, ASX is down XYZ, so much wiped off the market. The next day it bounces back, and the headline's not there. So for me, it's about pushing the noise to a side and understanding why we're investing, what we're doing, and then reinforcing the fact that the strategy of investing and what other parts of the strategy have you got there to be able to weather the storm when it does get volatile. And it's interesting how often you go to a social event and someone says, the market's no good. Are people calling you? I said, yeah, they're calling me, but it's not to sell, it's to buy. And I'm like, is it Are we at the point where we're catching the falling knife? Are we able to get back in? So it's an interesting one to really talk about news and things like that to make sure that you do push it out and you stay the course, because ultimately compounding returns, staying the course, quality assets, it's so critical to an overall investment strategy.
Yeah, absolutely true. Peter, here's a bit of jargon for you. Another big lesson is that the market is not the economy. So, how can you explain that really simply to a client without using the jargon?
Oh, you're testing me there, Jen. You know I love my detail. Um, Look, the way we always put it to clients is the market is very much forward looking. So if my recent experience, although it's not so recent nowadays, is during the period of COVID, when the markets did pull off at the start, but they became forward looking in the sense that, vaccines or talk of vaccines started coming through. People started realizing that governments around the world were starting to stimulate the economies and do things like that. So the market started looking forward to sort of say, well, we're going to get through this time, this difficult situation. We're going to recover from it. So that's when the markets themselves started to react that way, rather than focusing on the economic figures or the state of the economy at that one point in time. It started becoming forward looking of where the direction of where we're going to be in 12, 18 months time and further, long and short of it. Started looking to say, well, we're going to get through this COVID downturn and everything's going to be back to where it was before it happened.
Yeah, that's a really good answer. Thank you. Um, so it's interesting, retirement, we talk to clients, retirement isn't a daily scorecard. So many of them look at that as a daily scorecard. It's very much a long journey. And we need to remember that. We need to remind clients about that all the time. If we talk about, and Peter, you've spoken about the bucket strategy a couple of times, and this is really where a structure really helps calm, clients' nerves. So I really want to focus on and talk about those buckets. Warren, I'm going to throw to you because Peter's been mentioning it. In plain English, what does a bucket strategy actually do in helping retirees stay calm?
Well, as the name suggests, it's around putting different assets and different types of investments into the different buckets for the different reasons that you need them. The simple side of it is the cash bucket strategy is really ensuring that once you are retired and you're drawing on that income, there's sufficient amount in that particular bucket to fund your lifestyle. Now, depending on risk appetite and those sort of things, we look at having at least a year, potentially 2 or even 3 years worth of drawings or income that the client needs in that particular bucket for the purposes of meeting retirement, so that in the event of a correction, in the event of a pullback in markets, they don't have to sell things.
Mm.
That's the idea of the first bucket. The second bucket obviously is be the one, the longer term. Longer term strategy is what you need to be able to achieve. We talked about in a previous episode, inflation and the consequences of staying in cash too long and not earning enough in your growth. Reflecting on the time and value of money and how it changes so significantly. You need your bucket for growth. You need your bucket that allows you to achieve those longer term returns that compound over time to build what you need to be able to achieve in your retirement. So it's about just splitting out the asset types according to what they are needed so that you can use them appropriately.
Yeah, that's cool. So Peter, what do you typically hold in that sleep at night bucket? And what's its real purpose?
Yeah, Warren alluded to it before. It's really looking at holding that 2 to 3 years worth of your living expenses in cash and fixed term deposits. So, yeah, and we always talk about the fact that it is pure cash. It's not cash like securities and things like that. And as well as any expected larger lump sums that clients want. So, some clients come to you and say, look, we need to upgrade our car in the next 12 months, or they want to do a big overseas trip, or even large renovations to the home. So it's making sure they've got their living expenses mapped out, but also any expected lump sums within that as well.
Yeah, absolutely. Warren, back to you. You've said that having a cash buffer can stop people selling growth assets at the worst possible time, i.e., the example you gave about the client with badge pay. What's the behavioral win there?
It's really just about staying the course. It's understanding and it's not making a knee-jerk reaction to a situation that is not necessarily permanent. Like it's a temporary potential blip on the radar. It's a pullback. It's a normal correction as part of the market cycle. Having that cash buffer there means that you don't have to sell when it's unnecessary. And the challenge for people, if they have 1,000 shares of whatever it is, and that share price drops, and you have to sell, so you've only got 900 shares left, it takes a lot longer for that 900 shares to get back past where those 1,000 shares value was. So if you've got that cash buffer there, if you've got that bucket that says, well, I don't have to sell for 3 years, or for example, and then you got the income of those shares coming in along the way, if they're good quality blue chips or the like, that can stretch out to 5 years. And if you've got a good quality portfolio, there hasn't been a 5-year period in history where your assets, a diversified portfolio, isn't worth more than it was 5 years ago if you're able to stay the course with the same number of units. So that's really around just staying the course, having a buffer in there to understand that you are going to see periods of uncertainty and you need to stay the course.
Yeah, interesting. You both mentioned cash a lot, and you talk about cash, cash. We talk about cash, cash to our clients, fixed term deposits and cash, cash. Warren, I'd love you to provide our listeners with your explanation of why we don't recommend using mezzanine funds or fixed income type funds and funds with a twist of lemon sort of funds. So can you explain that?
Yeah, look, for mine, the bucket that's associated with cash and funding your income is the most important bucket. And the criteria it is, it needs to be there when it hits the fan. So for mine, trying to put your capital on the line to get 1% more than what you can in a cash and term deposit rate isn't worth the risk in our view, because it's those sort of funds potentially are the ones that we see freeze in the GFC, where they're frozen and unable to be able to liquidate when you need it the most. And if you're unable to liquidate these defensive managed funds or even potentially some ETFs, if you can't liquidate them, you then have to sell something, and what's left? Your growth assets when you don't want to sell them, which is the whole point of that strategy. And I guess that's where we're very, in some respects, simple and boring with our cash strategy, but it is cash to pay when you need it at the most important time. And I actually would argue that the best case result for some of those income funds is the fact that you get your capital back. Well, that shouldn't even be a question, really. You should be investing your defensively. And I'd almost skew to say, well, let's take a bit of that bucket and push it one to cash and one to growth, so that you get more growth and you get upside as potentially as well.
Yeah. Thank you for that. It's something that clients often ask me, and we forget it's just built in what we do every day. So it's great to be able to explain it. Well done. So Peter, back to you. When someone's fully retired, how should they think differently about investing compared with when they were still accumulating?
Yeah, it's a great question. I guess the one thing I first of all, we've touched on it before, is making clients realize that we are investing for the rest of their life. And that could be a 20, 30-year time frame. So normally what happens is clients get to retirement, they think they have to go conservative. So we talk them out of that. But at the same time, we can't be too overly growth orientated. And what I mean by that is there also a stage where we need to invest in more quality blue chip growth assets, not trying to pick the next penny stock or the next, fancy thing like Bitcoin or something like that, where people are supposedly making quick wins. It's about more so having a more considered approach with their investing, making sure that they've got their bucket strategy set up. So you've got your cash there for your living expenses, and you've got your good quality growth assets that, will go up and down with the markets, but they're going to be there when it hits the fan, and they're going to be the good quality assets that during your bad times are going to be the ones that generally recover quicker, because they are quality. They're not they're not the speculative stock that you hope is going to be the next winner. And that's, to me, it's more about not necessarily going less in growth, but more so better quality.
Yeah, true. So I'm throwing this one into the mix. How many times have you seen a portfolio client come in with a portfolio and it's full of their mates giving them a sure quick tip, or they're following that quick win that you just mentioned there, Peter, How many of those in a portfolio actually do really well, do you think, on an average percentage that you've seen over the years?
Yeah. It's very common for that to happen. Yeah, we get so many clients that come in, and that's that's the reality. I've unfortunately worked with a client recently who they went into an investment into a and this was actually more of a cash-like security that unfortunately wasn't what it was. There is so many of that, and in my view, it's probably the majority that actually don't really stack up. There's not really, they might get lucky with one or two, but generally speaking, the majority of them aren't, don't really perform in the long term.
Yeah, I've you're spot on there. Like it's actually interesting to have conversations with clients about how they've ended up in stocks like that. But I guess one thing I always remember is very early on in my career, I spoke to an original mentor of mine who used to talk about he started deviling, trying to pick the next winner and doing all those sort of stuff. And he goes, the first time I actually have made proper money is when I started treating myself like a client. And for what that means for us is that there's no quick win strategy. For every winner, there's 1,000 losers. Like, the ones who pick NVIDIA versus something else, or the ones who pick the Zinifex or the mining stocks over the time. There's 1,000 of other ones where people are going into them, and it's essentially punting really rather than investing. So I just caution people to treat themselves like it was someone else's money that they're taking the time to invest in. Stick to quality and take a long-term view and use things like reinvesting back into the market with your dividends, buying more, averaging, dollar cost averaging, buying and taking time and let compound interest work for you over time, because the quick wins are very far and few between.
It sounds like horse racing to me.
Yeah.
You can get the winners and you get a hell of a lot of losers.
Oh, yeah.
Warren, I'll stay with you. So there's a big myth that once you retire, you should be ultra conservative and you should sit in cash. What can actually backfire by following that sort of myth or strategy?
Well, it's pretty interesting to reflect on the cost of living and how that changes over time. Inflation, we're seeing more and more in front of mind at the moment, particularly around the world with where economies are at and what RBA and central banks around the world are having to deal with. And if you don't beat inflation consistently over time, the value of your money decreases and you're not able to achieve what you want to achieve. So sitting in cash, which arguably is only a margin over inflation at best, longer term is not going to necessarily achieve what you're wanting to achieve. And so that is, in a way, going backwards without actually going backwards.
Absolutely great points there, Warren. So, Peter, over to you. What's the more useful way to think about being conservative? Is it the asset mix, the time horizon, the income plan, or the behavior plan?
Yeah, great question. It goes back to what we've been talking about. To us, the conservative plan is that bucket strategy. It's making sure that you've got 2 to 3 years worth of living expenses, any expected large lump sums sitting in cash. So that's where that asset mix comes in. And then time horizons, make sure that you've at least got 2 to 3 years. Plus then, as Warren said earlier, you've got the income and that coming in from the investments. That to us is the conservative part of the portfolio and the conservative part of the plan for our clients.
Yeah, good point. So, I want to change tact a little bit and talk about risk appetite and mindset. In chapter 5 of the book, we talk about the pace analogy, the cautious walker, the adventurous runner, and the marathon investor. Peter, to you, which pace do you often see most in retirement with clients?
Yeah, it's a great. We sort of spoke about it in an earlier episode and earlier this time. What I see when people are approaching retirement and they're starting to think about retirement, that's where they become the cautious walker. That's when they start thinking in their mind that I need to be really conservative. And as we spoke about, that's where they start thinking, I don't want to lose the money that I have. But where we transition clients to and help them realize is we turn them into more the marathon runner. We're sitting here, we've got a nice investment strategy, we've got that bucket strategy set up for them. And reality, what we're doing is we've got a plan in place that's going to set them up, because you need to be a marathon runner when you're potentially funding your lifestyle for 20, 30 years. and you're not necessarily having other income or that coming in to top up, your super bucket or whatever it is. So we need to make sure that the portfolio, you've got enough for your sleep at night fund, as we called it before, but then your other assets are working to make sure that we offset the longevity risk of your money running out, 20, 30 years down track. We've got to make sure that portfolio is, as they say, it's the tortoise and the hare. The slow and steady wins the race, and that's what we set up with clients' portfolios, and that's where that marathon runner comes in. It's again, as we spoke about, it's not doing the speculative stocks, the penny stocks, the next winner. It's doing the good quality assets that will. They're just slow and steady, but they work. They continue to grow. They give you the dividends, and they get you through to the end point.
So we don't want sprinters, we want marathon runners.
Correct.
That's cool. Warren, here's a bit of a coaching question. When a couple have two very different paces, one panics and one shrugs and goes, it'll be all right. How do you coach them back to a shared plan where they're both going in the right, I shouldn't say the right direction, but the same direction?
Yeah, it's just conversations really, and making sure that each person listens to each other's point of view and each person understands the consequences of making a particular decision. Like risk profiling, and so to speak, is an interesting topic because often I've had different examples based on their history. So still remember a 90-year-old lady coming in very early on in my career talking about, I don't want anything risky. I've never seen a financial advisor before. I don't want anything risky. I want to be really clean and easy and don't lose any money. I want 100% blue chip shares. And if you look at the textbook, having everything in blue chip shares is considered growth. So the word is exactly the word. It's your interpretation, your understanding about risk profiling. It's really critical. So while someone might say that they're very conservative, when you work through the questions and their history and what they've invested in and whether they've run their own business and whether they've borrowed for purpose of investing or anything like that along the way, what they say and what they've done and what they want is often different things. And that can be conflicting in a couple as well. And I guess it's all around having a conversation, and, we can go down the path of having two portfolios. We can go down the path of meeting in the middle. Often it's just around making sure everyone's on the same page and having an open and honest conversation. And that's with everything in relation to retirement, not just investing.
Absolutely. I lose number of fingers to count on my hands that the number of clients that are conservative or balanced, but they've got 95% in blue chip shares, as you say, and it's because they know and understand it. They know what CBA does, they know what BHP does. And so they're really comfortable and they're not worried about, market fluctuations for that reason, because they understand what the underlying company does.
Similarly, even with people who've invested in property in the past, they all say, I don't want to take any risk on blue chip property. And I'm like, well, okay, that's fine. But you understand that investing in a property, that if you sell it one day versus another, you're going to get a different price. And I think that's also, maybe it's an Australian thing, I don't know, but we've got an appetite for property in Australia, and people understand property, that it's not a short-term investment. Yet in the minds, sometimes investing in the share market is different perspective, yet ultimately it's the same thing. And when you're comparing shares with property, it's really interesting, the fact that, you come home every night and your share price is up on the news versus you come home every day and there's not the price on top of your house. So people have a one mindset for property sometimes, and they need to think about the shares in exactly the same thing. If it doesn't matter what the price is unless you're selling it. And so explaining those sort of things let you develop an understanding about how people consider their money. And then you just talk about, well, if a husband wants one thing and a wife wants another thing, well, let's come to the party and have a compromise and a discussion around what that means. And sometimes people become really conservative, and then, as we talked about before, if you're too conservative, you might not be able to achieve your goals. So it's just, our role is to coach and educate and discuss these sort of things so that people can make informed decisions.
Yeah, very true. And very true point about, if you're too conservative, then you may not be able to achieve your goals. It's a point that a lot of people don't think about, because they don't realize the flow on effect from there. So, Peter, anything to add in terms of a mindset shift that can really help people stop reacting to those headlines that Warren was mentioning? Because as he said, there's not a price tag on the front of your house every night you come home, but it is on the news. How do you coach or how do you help clients with that mindset?
Yeah, sometimes it's a bit of a difficult one because, as I said earlier, sometimes clients' past experiences, it sort of, um dictates what their current strategy is. Sometimes, they've been burnt in the past, things like that. I guess what I keep reiterating and getting back into clients' minds is what Warren said before, headlines sell, bad news sells. So, you're always going to hear about the bad news stories. Not going to hear about, as Warren said, one day the market drops, next day it's up. You're not hearing about that. So it's basically helping them realize that you got to stop reacting to every little headline because whilst I get where they're coming from, and it is a hard thing to sometimes do, especially as we said, this is the money they'll ever have. It is just understanding that, you can make a bigger mistake and cost yourself more money in the long run if you do just react. I remember we working with a client who every time the market started getting choppy, they suddenly really want to go ultra conservative. And over time, we've coached them about this, and they're now in the stage where they turn around and say, we don't even look at the news anymore. I don't watch the market news. I don't really look at the headlines anymore because they knew that they were reacting and not reacting in the right way. So it's just coaching. And as we touched on before, it's coaching that, when you log in online, you look at your portfolio or you're looking at, a sea of red on the TV or whatever it might be. Again, it's on paper losses, not real losses.
So it sounds like it's consistent reinforcement of almost the same message over and over again.
Yeah, correct. And that's what, our value is with our clients is we are that sound reasoning to help them go. I remember working through the COVID and, the phones were almost, clients ringing, what are we doing? What are we doing? The market's crashing. Should we be doing something? Should we be selling out the cash? And it was just that constant reinforcement of what our investment strategy was. The fact that we've got that bucket strategy for them. And it was that, as you said, that constant reinforcement that you're going to be okay. And you've got enough cash in your portfolio to get through the volatility. And as Warren said, whilst we sit there and say there's 2-3 years worth of cash, some clients I'm sitting there going, well, when we include the dividends and stuff, you're probably actually going to be okay for 5, 6, 7 years even. And by then we will have forgotten about all this.
Yeah, it's very true. Warren, back to you. Give us your top 3 stay calm actions a retiree can take over the next, 12 months, 2 years, 3 years. Obviously, we've had recent market volatility, and maybe reflect back to COVID and the GFC because you've been around for that long.
Thanks, Jen. Stay calm actions. Okay. I think, well, we talked about it. I think you got to remind yourself that bad news sells. So remember that when you're looking at your news, when you're looking at Facebook or Instagram or whatever else, they're looking for clicks. They're looking for headline grabbers, and markets up 2% on a rebound isn't one that generally gets a headline as much as what it does if it's down, 1% for the day. So I guess my stay calm tip, so to speak, is to really focus on what's important around the news and what's important around that, without digressing too much. I still remember hearing a story about the guy from the Beechworth Bakery back in the day talking about what made Beechworth Bakery successful. He said, well, I stopped watching the news. I turned it off every day because all it was negative, and it made me feel bad. And it made me as a person turn around and become a lot more positive and focus on what was important. So just a bit of thought to something around that. Secondly is don't look at your portfolio every day. I remember having a conversation with a client saying, I look at my portfolio every single day and it determines what sort of day I'm going to have. I'm like, you got to be kidding yourself, don't you? Like, it's every single day is too much. You should be looking at it monthly at most, really. Look at, if there is a correction, look at it as there's a buying opportunity. Look at, a review in totality of what you're holding and why you're holding it rather than the balance. If the balance is, if it dropped 1,000 or up 1,000 in one particular day, it doesn't matter because you don't need it yet, or you either that or you're living on the income, And probably the third, and probably where we add probably the most value is take the emotion out of investing. Try to remove the emotion and the passion as to because when we've got doing things on emotion, often we don't make the best decisions. And having conversations with trusted people is so important. Ensuring that you've got that person who is devil's advocate, so to speak, is the person who can put things in perspective is really important. Because often in a market correction, if you actually look at the graph, we're only back to where we were 3 months ago, and you're probably happy with 3 months ago where the value was. So think about things and put things in perspective. Is that 3? I don't know. There you go. There's more than you are, Jen.
I lost count. I was focusing on you. Peter, anything to add to that? Or conversely, have you got, tips of things not to do if the market's being volatile or in a downturn?
Yeah, I think what Warren's covered most of it. It really is just going back to basics and remembering what the strategy is, remembering what investment plan that you have in place. And that's really important. And as Warren said, we say to clients all the time, you've got to turn down the noise. And I know it can be hard, especially in this day and age, even when everyone's on their phones or things like that. That is the real, I guess, it's attention grabbing. So people do react to that. But it's just bringing back people to the basics of understanding and remembering what their investment strategy is, and remembering that we're investing for the longer term. So we don't need to make a reaction now on just one little piece of information or one event that's happening now. We need to focus on the long term.
Yeah. So I'm hearing it comes down to this: have a plan that you can point to when emotions are running high. Build in buffers and make sure that you're not forced to sell at the wrong time. Remember that diversification is a seatbelt. I'll use that car analogy that, I'm not into cars, but I'll use that one. But, that seatbelt, it doesn't stop the bumps, but it helps you stay in the car. So I think that diversification. Changing tact again, because I like to do this. Warren, what does thriving look like in retirement, not just financially, but day to day, and especially when you bring the markets and volatility into the question and the equation?
Thriving, I guess, from an investment point of view, is probably around understanding and ensuring and having a portfolio sitting there that is able to weather the storm in all sorts of market conditions. It's understanding that the strategy allows for bumps along the way. It's got protection, but yet comfort, and you're able to sit there and take positives out of the fact that while there is the market volatility going on potentially at the moment, you're going to be okay because it's planned for in the strategy. I mean, the reality is, if you're going to be a growth investor, you're going to have a negative year every probably 5 or 6 years anyway. So just be ready for it and have the portfolio sitting there, and don't try and time it, because we can share all the numbers you want, but if you try and time the market and you miss the best 10 days in a year, you miss out on generally the majority of the year's return. So trying to time it by the time you do, brokerage and tax potentially and those sort of things, it's challenging, and therefore someone who's thriving in my mind is staying the course with a strategy that's robust and sound and able to weather the storm in all market conditions and cycles.
So it's almost like your client that came in with the 100%, 95% blue chip shares. She probably hadn't looked at what the value of that total portfolio was in years, but just knew that the dividends were coming into her bank account every year or every May, twice a year. And so knew that she had enough money to survive on.
Yeah.
But then, when you start reporting it to them, and this has happened with me with a client, you start reporting and they're like, oh, I didn't realize that the portfolio was that much.
Yeah. It's the whole fruit tree analogy. If you're thriving in retirement, you've got a portfolio that's the tree that's growing along the way, and you're living on the fruit. Like that's the real dream in retirement, and you do it in an environment where you pay zero tax. I mean, how good's that? So For mine, it's about ensuring that you've got quality, you're taking a longer term view, and you're enjoying that environment in all market conditions.
Yeah, that's cool. Peter, what do you think, when clients come in, that the part of retirement that they're quietly looking forward to? And how do we protect that when markets wobble? Is that through the coaching and the way we plan the portfolios, or how do you see that?
Yeah, it's all of the above. It really is making sure they've got the right plan in place. They've got that bucket strategy. They've got, that understanding and that comfort that they know that they've got money there where they need it, even no matter what the markets are doing. And I find it really powerful, to extend on what Warren said with thriving. I love it when clients, coming to us, we have a meeting with them. And even if the market is volatile or bumpy at they're not focused on that in the meeting. They're not even talking about the markets. They're more telling you about what their retirement looks like, how much fun they're having, how awesome it is. And it's really cool when, I sometimes get people, friends and family talk to me, oh, you guys must be really busy. You must be having lots of clients call you right now because the market's chopping. I go, no, because they know the plan that they've got the strategy, and they're not worried about what the markets are doing. If anything, it's maybe a couple of calls from those other clients that turn around and go, what am I investing in? What can we buy now? So that to me is I just want to extend on Warren's thing around the thriving. It's having those clients that aren't actually worried about what the markets are doing. They're having their epic nap, as you call it, Jen, in the book, and they're just enjoying their best life.
Yeah, absolutely. I think that's a great place to wrap up for this episode. So thank you both for joining. Thanks for giving sharing some of the I guess the tips and the strategies that we look at within JBS. So thank you, Warren. Thank you, Peter, for doing that. So in closing, retirement is more about than being prepared. It's about enjoying the life that you've worked really hard to build. If today's episodes made you realize that you'd love a clearer plan and a calmer headspace, then please reach out to one of the team at JBS. We would love to have a chat with you, because thriving should be fun and naps should be epic. Thanks for listening to Retirement: The Great Escape Plan. If today's conversation raised questions for you or simply gave you something to think about, that's a great place to be. Retirement isn't about having everything figured out at once. It's about starting the right conversations and taking thoughtful steps over time. You'll find helpful resources and references related to this episode in the show notes. For more tips and insights and practical guidance, we also invite you to visit the JBS Financial website, where you'll find a range of tools and resources to support you at every stage of retirement. You can also follow JBS Financial on Facebook, LinkedIn, Instagram, and YouTube for ongoing conversations, updates, and ideas to help you plan well and live fully. Join us next time as we continue exploring what really means to plan well, live fully, and enjoy retirement on your terms. Because thriving should be fun and naps should be epic.